This is level 1 of the CFA program, the topic on corporate issuers, and the reading on Introduction to Corporate Governance and Other ESG Considerations. This is a fairly long reading, and we have nearly 50 slides in this slide deck, but the overwhelming majority of the focus of the reading is on corporate governance. And we'll spend about 20% of our time on environmental issues and social issues at the end of the slide deck. But I want to call your attention to the first, 10 or 15 pages of this reading. This is everything that I teach in my corporate finance class that answers questions that sound like, what is the structure of a business? What is the structure of a corporation? And how does it essentially make decisions? And you'll see that as we go through these learning outcome statements. Notice that the term corporate governance is in a handful of these. We'll talk about the principal-agent relationship, and then we'll go ahead and start with a discussion on the different stakeholders. Now, what we learned from Modigliani and Miller all the way back in 1958 in their seminal capital structure paper, and by the way, that's a point of emphasis, and well, it should be by the CFA Institute, we learned that the goal of the business is to maximize shareholder wealth. However, in that maximizing shareholder wealth, there has to be a consideration of other stakeholders, and the Institute is pretty concerned about all those other stakeholders. And then at the very end of the slide deck, we'll go ahead and talk about how, as good financial analysts, we can use environmental factors and social factors and governance factors to become better decision makers to help our clients make more effective, make more efficient, and make better decisions. Let's look at that first LOS. Describe a company's stakeholder groups. And then ask the obvious question that, all right, if we have a handful of stakeholders, do they all have the same goals? So there's probably going to be some conflict of interest. So what I want you to do is I want you to visualize a balance sheet. We've got assets over here on the left-hand side, liabilities and equity over on the right-hand side of the balance sheet. What we learned from Modigliani and Miller all the way through Milton Friedman and all the way through the Business Roundtable is that the goal of the business is a focus on maximizing shareholder wealth. So the shareholders, as the owners of the business, are the primary stakeholder. That's why they're listed as number one. So what do you learn? What have I taught you in some of these other study sessions? How do executives make decisions that maximize shareholder wealth? Well, a handful of ways, right? Find projects in which they can be, those projects and those product lines can be made for pennies and sold for dollars, right? We want a little on the expense side of the income statement and lots over on the revenue side of the income statement. We want to develop brand name product lines. We want to generate projects that have lots and lots of operating cash flow. So there are lots of ways that we can do this. However, we need to be concerned about the other stakeholders, right? So look at that first teardrop point. Corporate governance systems can be and ought to be influenced by several stakeholder groups. So moving up the right-hand side of the income statement, we have all those organizations from whom the business has borrowed, right? Accounts payable, we probably won't talk about that too much, but we will talk about bank loans. We'll talk about private bond issues or private loans, and then we'll talk about bond issues. So what's the goal of the business in terms of the top right portion of the balance sheet? Well, the goal is to find projects that are going to be able to return the interest and the principal to those who provide us with that capital on the top right-hand side of the balance sheet. All right, how about other stakeholders? I always refer to these as the executive leadership team, which includes the chief executive officer. And what we've learned in other readings is that the CEO and the chairman of the board, boy, we should probably separate those two positions. Now remember, it's the board of directors, so skip down to number 5. There's the board of directors. Who are these individuals? These are elected by the shareholders. So the board of directors are the group that's responsible for being good stewards of the shareholders' capital, and then by implication, good stewards of the bondholders' capital. Because remember, on the right-hand side of the balance sheet, those are the sources of funds. So look at the words here that we put on the slide deck. Safeguard their interest, provide strategic direction. And you've heard me say this before, but I think it's worth repeating. The board essentially has two functions. The first function is to decide on the direction of the company. Management and marketing people, they call that a strategic plan, or in this case, a strategic direction. But the second function is for the board to hire and fire the executive leadership team. And so the board then, as good stewards of the shareholders' capital, have to consider the performance of the managers in terms of their ability to generate enough operating cash flow so that we can meet all of the goals and satisfy all of these stakeholder groups. And then, of course, look at number 4. I didn't forget about this. After we went through COVID in 2020 or so, it's almost a daily piece of our language when we say the term supply chain and supply chain obstacles and supply chain issues. But before COVID, this was not really too well known of a terminology. But it is now. So, of course, I always tell my students, and by the way, my students, they love the Bloomberg terminals that we have in our finance lab. And the Bloomberg terminals have a tremendous supply chain function. And so I always do this to my students. I say, look at the supply chain on that side and look at the supply chain on that side, whether we're demanders or suppliers of, those individual units that move through the chain. We need to consider those as stakeholder as well. Others, customers, regulators, and governance. All right, so let's go ahead and compare this shareholder theory, which comes from Modigliani and Miller and Milton Friedman. Shareholder theory. We elect the board of directors. They hire and evaluate the performance of the managers to serve in the shareholders' interests. And so look at that block point there. And, this is interesting. I think we could have tons and tons of a conversation about this. But the interest of other stakeholders is considered only to the degree that they have an impact on shareholder value. So lots of people think that there are some holes and some criticisms going back to Modigliani and Miller and Milton Friedman in this shareholder theory. But I want to call your attention to this Friedman Doctrine, and this probably has nothing to do with the exam. But if you read the sentence that Friedman says, he talks about, best interests of shareholders, but there's not a period after that. There's a comma. And Friedman states very clearly after the comma that as long as the business operates within the legal framework and doesn't consider fraud and misrepresentation and a couple other terms in there. So in my estimation, Milton Friedman was considering all of these other factors that we're talking about in here. And so there's probably a good separation between shareholder and stakeholder theory on the exam. So I would remember that, considered only to the degree that they have an impact on shareholder value, because that comes right out of the reading, and that is described in the LOS. But once again, we could have lots and lots of great discussions about this. But my focus for you guys is to make sure that you get these answers correct on the exam. Now, stakeholder theory, on the other hand, says something like, all right, let's go back here. And of course, we want lots of profitability, but we also want profitability that does not occur at the expense of all of these other stakeholders. So we need to consider the environmental, the social, and the governance factors. Now, this is super important there. This comes with several challenges, and these are probably really good exam questions. So balancing multiple objectives. Those of you who are living through inflation in 2021 and 2022 and probably beyond will know that lots of firms have raised their prices. But let's go ahead and ask about the social impact. Are firms going to say something like, we're not going to raise our prices because we're going to do our best to combat inflation for all of the customers out there? Well, the question then becomes, all right, so if a business doesn't raise its prices, but its input costs are increasing because of inflation there, that lowers its margin, and then it reduces the operating cash flows. So clearly there is a balance. And what I tell my students all the time is that what it basically comes down to is a marginal cost, marginal benefit decision. So balancing multiple objectives is super difficult. Defining and measuring non-shareholder objectives. Look, this is why we went through the recent reading on capital budgeting and capital investment. What do we know? We know that firms want to invest in projects, and their shareholders want the executive leadership team to invest in projects that have positive net present values. That is an easily measurable metric. The net present value is 10. Well, that we calculated that. So we can hang our hat on that 10 and say, yes, shareholder value is going to increase by 10. But how do you measure the social impact of, well, let's just go back to my previous example of not raising prices, and so you don't contribute to higher inflation? Boy, does that lower the inflation rate by 1%, or does it lower the inflation rate by 0.0001%? So it's super difficult to measure non-shareholder objectives. But I promise you that there are lots of really, really smart men and women out there who are trying to come up with some kind of a quantitative metric that will lessen that particular challenge. And then, of course, we have competition, not just inside of a country. Let's just pick the United States since that's where I am. But we're competing against firms that are outside the United States that may or may not have similar standards. Maybe they, in fact, have polar standards. And so it's probably difficult to compete with those people, with those organizations. Yeah, considering these other interests increases a company's costs. All right, so that's on the left-hand side of the income statement. And so we're going to have these extra expenses thrown in there, which then shrinks our margins and lowers the operating cash flow. And so, 2, 3, and 4, those are important, but the first one is probably the most important. All right, so let's go through these different individual stakeholder groups. And I've probably mentioned much of this that shows up on the slide. So the shareholders, they are the owners of the corporation. That makes perfect sense. So what's the goal of the business? Maximize shareholder wealth. And so the shareholders are interested in profitability. And so that comes right out of the reading. But what I'm going to do is make you just aware that profitability can be measured by many, many different metrics. Let's be careful about net income, because as you remember from our financial statement readings, that the accountants have lots of leeway, so they can massage the financial statements to make the firm look better than what it actually is. So when you think about profitability, think about operating cash flow, the amount of cash remaining after all expenses have been paid. And what that means then is that, we switch that net income or operating cash flows. I mean, I'm not an accountant speaking here. We flow that back over to the retained earnings portion of the balance sheet. Now, the reading does have a couple of paragraphs on controlling shareholders and minority shareholders. And this is probably a good exam question. So I want you to think about this. Let's suppose that I'm Jim and I have Jim's Concrete Company. And I own, and my wife and my children and my family members, we own, let's say, 60% of the company. And we have an initial public offering. And so you guys out there, you buy my shares and you own 40% of the company. So my family and I, we control the decision, because essentially we control the election of the board of directors. So we can put on the board, we could put ourselves on, or we could put Santa Claus on, or anybody that who we wanted to. Now, you guys as the minority shareholders, what did I say? 40%. You guys are not without influence in the decision making of the company, even though you don't have a direct representation on the board of directors. So that's why the reading emphasizes this limited ability to exercise control. But I want to emphasize it's not no ability to exercise control. And of course, I say this to my students all the time. Look, oops, I accidentally bumped that. I say this to my students all the time. Look, the minority shareholders, if the minority approached me and my family and said, you know what, we think your cousin over there who's running the business in that part of the state, we think that he's doing a terrible job. What do you think? Now, if the minority shareholders come to me and they just start criticizing my cousin over there, I'm just going to probably shut them down, right? This is my cousin, right? We play basketball together. We go to football games together. But if the minority shareholders come to me and say, you know what, we're concerned about that part of the state over there. Look at the cash flows. They're a little bit less. What can you do to improve that? So you see how the working together is so important. And I think that's a point of emphasis in this reading. Let me go back here. The working together of these different stakeholder groups to arrive at a singular goal that benefits everybody. But once again, that singular goal is difficult to measure. All right, I probably mentioned all this in the top right-hand side of the balance sheet, right? Debt financing, interest and principal. So what do? We promise, as the corporation, we promise those bondholders an explicit promise. I promise to pay interest and I promise to pay principal. One of the interesting things about managing the top right-hand side of the balance sheet is that there are lots of different sources. We can go to a bank, we can go to private lenders, we could go to private equity, we could go to venture capital, we could go to the public markets. And so each one of those debt holders, let me use that generic term, each one of those debt holders probably has a unique perspective about why they're interested in lending the corporation money. So just pay attention to those little differences. All right, board of directors. So I've already said this. Responsibilities, hiring the CEO, monitoring performance, right? That makes perfect sense. Boy, that third block point is really important. And this started, probably in the late 80s, but then in the 1990s, with Dick Grasso and the New York Stock Exchange saying something like, look, we need to move to a majority of independent directors. And in fact, if you look at the composition of the board of directors, in fact, every semester I take my students to the Johnson & Johnson board and I show them. And in 2022, I think there's 13 or 14 board members, and all of them except for the CEO are independent, and they all have expertise. And if you look at these individuals and read their bio, you pretty much come up with the idea that, boy, these are really, really smart men and women that are experts in their field that are going to be able to efficiently, boy, what are those responsibilities? Protecting the shareholders' interest, hiring the CEO, and monitoring the performance. All right, the managers, of course, the CEO is the leader. What do the executive leadership team and then upper management, what do? They visit with the board of directors who establishes this strategic plan, and they say, okay, this is how we're going to do it. For example, if I'm Jim's concrete company and my board of directors comes and say, you know what, Jim, you're really, really good at making concrete. What we want you to do now is we want you to start building homes. So not only am I going to am I an expert in, what goes into concrete, sand and rocks and water and mud and all that kind of stuff. What do I have to do now? Now I have to become a forester, right? I need to know how to plant trees and cut down trees and replenish trees. And then I need to say something like, look, if I'm harvesting all these trees are there. What do? They consume the carbon that's out there. So I need to replace those trees, et cetera, et cetera. So what do we say right here? Smooth functions of day-to-day operations. All right, employees, in the old days, lots and lots of individuals would look at labor expense on the left-hand side of the income statement and say, okay, that's what I think of my employees. It's just a line item on the income statement. But nowadays, this goes back at least 30 years, maybe even longer than that employees ought to be considered an asset. I mean, clearly there's a contract, right? The corporation says something like, here's a compensation, and that compensation could include a salary, it could include bonuses, and it could include benefits, like a company car or a country club membership. And what's that in exchange for? The exchange is for the expertise that individual brings to the firm. So the more we pay, the greater skill set that we're going to get in return, or at least that's kind of the thought. What do the employees want? They want to consume salaries, they want to consume stock options and all that kind of stuff. But they also want to be able to say something like, boy, you know what? I just bought a house. I have a mortgage for 30 years. It'd be nice if I had a job for a long, long time. And so do you see the difficulty there in balancing these interests? The only way these individuals are going to have a job through their mortgage payment is if the business generates lots and lots of cash flow to be able to satisfy not only the labor expense on the income statement, but all of those other expenses. Customers, of course, you don't need me to tell you anything about this. You guys shop at Target and Walmart, so you know what it's like. What it's like to be a customer. Suppliers, same thing there. And governments. Let's go ahead and just make a simple comment here. This is probably a good exam question. It's probably an easy one. The government is allowed to make up the rules. And so those rules, typically are called laws, but they could be regulations. They could be all sorts of different standards. And then, of course, on the bottom left of the income statement, there's a tax expense. And so the government, both at the federal level and at the local level, gets to take away some of that income. All right, so what happens here? In the course of the lifetime of a business, it borrows a lot of money on the right-hand side of the balance sheet. It uses that money, uses that capital to invest in long-term assets that generate product lines or services. And so this is, what I think of as kind of a really efficient, I'll call it, maybe a corporate cycle. And what happens is the executives then invest in these product lines and services, and they generate cash flow. And from that cash flow, the shareholders get dividends. And from that cash flow, the bondholders get an interest payment and a return of principal. So this is kind of a perfect thing. But it's not perfect in that there is this principal-agent relationship. The executive leadership team is an agent. And they are hired to act in the best interests of the shareholders, right? Now, this is all done through the board of directors. So what we have to do is we have to be aware that the agents, the executive leadership team, are tempted, right? Back in our economics reading, we learned that individuals act in their own self-interest. And so imagine that you're a chief executive officer and you raised a lot of capital on the right-hand side of the balance sheet. And let's just suppose that amount was $1 billion. So you show up for work the next day with $1 billion in your pocket. Now, of course, you made a promise. You made a promise to the people on the right-hand side of the balance sheet. You said, look, I'm going to take your money. I'm going to be a good steward of your capital, and I'm going to invest it in this new product line. Think of Jim's concrete company. I'm going to start investing in trees and forests and 2x4s because I'm going to build homes. Not only am I going to build the foundation, but now I'm going to use the wood to build the frame on the home. All right, so I'm going to do my best to become an expert in home building. But think about what you're tempted. You're tempted to think that, man, I'm the greatest CFO that ever lived. I just convinced $1 billion worth of people, $1 billion worth of investors to lend me their hard-earned capital. I deserve a raise. I deserve a bonus. I deserve more administrative assistance. I deserve a bigger office. I deserve a limousine service. I deserve a country club membership. I deserve, right? So what do we call these? These are called executive benefits. And shareholders are perfectly happy to pay for executive benefits if they increase the cash flows of the firm. The example that I give students all the time is a membership in the country club. Do shareholders want to pay $50,000 or $100,000 to have the chief marketing officer have a membership at the local country club? And the answer is, well, I'm going to do this again. Marginal costs versus marginal benefits. If the marketing executive is just going up and playing golf and tennis and ignoring his or her responsibilities, then the answer is no. But if the marketing executive is using the country club to bring potential customers there to play tennis and golf and swim and eat lobster and steak, and all of a sudden these potential customers call us and say, you know what, give me 10,000 of whatever it is that you're selling, right? Marginal cost, marginal, and marginal benefit. So look at that second point. The principal-agent relationship involves obligations, trust, and expectations of loyalty. So it's up to the board of directors to monitor the executive behavior as it relates to the consumption of those benefits. I love talking about that stuff. Do yourself a favor and type in Dennis Kozlowski and Tycho and see what Dennis put his shareholders through. This is somewhere around the year 2000. Fascinating story. All right, here's an example of this conflict. So shareholders expect to maximize cash flows. Managers want to maximize their own personal wealth. This is what I was talking about here just a few moments ago. Are you ready for this? If you're the executive and you have a choice between investing in a branded product line or investing in a new product line, how about if I use this example? I think I used this in just a recent one, but it's relevant here. You know, let's suppose we're Hershey Foods and we have these brand product lines, right? The Hershey chocolate bar. So maybe we want to expand this to another country, or maybe we want to make more chocolate bars in this particular part of our country, or. So let's suppose that's going to cost us $100 million. Or we have this other choice. We could invest $100 million in a breath mint. Well, what do shareholders want? Shareholders are going to say, you know what, there's not a lot of growth in Hershey chocolate bars. You know, pretty much we sell it to all the people that want it. But we don't do anything about breath mints. Let's go try to capture the bad breath market. And of course, Milton Hershey developed this icebreaker product line, and it's after 20 years or so, it's now its own brand name. But you see the point here. The shareholders, they want riskier projects because they want to capture the upper tail of the distribution, but the managers, they probably don't want that. What if they invest all their capital in the icebreaker product line and it's a total failure? Well, they might lose their job. There's some examples. Entrenchment, that's what I was talking about. Empire building and excessive risk taking. All right, agency theory and agency cost. This is what I was just talking about. Agency theory is just this idea that there is a principal and there is an agent, and they may or may not have the same goals. Agency theory, right? So agency costs then are the costs to try to attempt to reduce that agency conflict. And these are mostly monitoring costs. So what does the board of directors do? Well, it has a compensation committee, and so this compensation committee will determine whether or not the executive it warrants an investment in a country club membership for that executive, and then it'll have to monitor the receipts. So if the receipt comes in, Monday, Tuesday, Wednesday, Thursday, Friday, I'll just use myself as an example. Monday, Tuesday, Wednesday, Thursday, Friday, Jim went up to the country club and had lobster and steak and bought a case of Budweiser and didn't come back to work in the afternoons. Well, that's a clear indication that I'm probably not doing my job. But if the expense report comes in and says something like, Jim hosted a potential client over here that's going to build homes in that area over there. A potential client, he went golfing with a politician who has a law that is likely to be passed, et cetera, et cetera. And, so agency costs, these are the marginal costs that I was talking about in the marginal cost, marginal benefit kind of a discussion. And then there's there's what's known as the residual loss, and that's the excess consumption. So imagine if well, let's not take my extreme example, but let's suppose that instead of a case of Budweiser, I only have 3 Budweisers, and I come back to work and I don't do my job as efficiently because I've been drinking at lunchtime, and so my productivity falls. I'm not popular in the office. All sorts of bad things can happen according to that. So the agency costs are lumped into all those costs that try to reduce that conflict. And I encourage you all the time to read the Wall Street Journal. There are articles on there regularly about executives out there who do something like I just described. Now, remember a few slides ago, we talked about this difference between the controlling shareholders and minority shareholders. There's another section in the reading that goes into a little bit more detail. But remember what I said just a few moments ago about, how the minority shareholders ought to approach the controlling shareholders when there's kind of a conflict. What I was suggesting earlier is that there probably was a concentrated set of minority shareholders. And so think about this. We can have dispersed, we can have shareholders all the way over, or we can have this concentration, whether it's a controlling or a minority or some kind of a hybrid. And this is what I was saying earlier, that depending on those different types of concentrations within the ownership structure, there could be conflicts of interest between and among each one of those. So over the years, to kind of lessen this conflict, corporations have come up with some pretty interesting ideas. Dual class shares, where there's Class A shares that they get to vote for board of directors. Class B shares, they don't get to vote at all. I mean, that's an extreme example. And so you can divide the dual class shares into almost anything that you want. Look at the last arrow point. Mitigate the dilution of voting power and continue control of the board of directors. And so, there's all different sorts of things. There's all different sorts of ways. There's cumulative voting. There are classified boards. There's all different sorts of stuff in here to try to influence how the board can look beyond just the maximizing of the shareholder wealth goal. Oh, this is super important here. Information asymmetry. In fact, in that 1958 paper, Modigliani and Miller assumed what were known as homogeneous expectations, meaning that everybody, both inside and outside of the company, had the same information set about the product lines of the business. And that was clearly a limiting assumption. But even they, in the latter part of the paper, said, this is really not true. The managers probably have more sense of the quality of the assets than someone like me, just a regular old shareholder. Let's go ahead and piggyback on that agency description that I gave you about searching for risky projects, the Hershey chocolate bar versus the icebreaker. Well, the same thing holds true with the bondholders. Bondholders prefer that Milton Hershey invests in more chocolate bars and less risky projects. No, not less risky projects, but projects, they want projects that are less risky. Yeah, I think I said that the right way. All right, corporate governance. Here's a good definition to memorize: a system of checks and balances and incentives. That's really important. So the compensation committee of the board of directors is responsible for creating a compensation package under which the executive leadership teams feels like they're a valued asset to the business and that they don't really have an incentive to consume all of these extra benefits. In the academic world, we call this an excess consumption of perks. And what this does is it manages all of those conflicts, not just between the shareholders and the executive leadership team, but between and among all of the other stakeholder groups. Yeah, corporate governance outlines the rights and roles and responsibilities of various persons. And, I think you've heard me say over the years listening is that, I'm a gigantic sports fan, and I was somewhat of an athlete in the old days, and my children as well. And I've always said to my children when they say something like, oh, something about their coaches, and I'm like, look, go up and ask your coach, like, what do you think is my asset and what do you think is my liability? Think like an accountant. And so I think that a great coach identifies accurately the roles of each player on a team. And of course, that's got to be a function of a good corporate governance strategy. Rights, roles, and responsibilities. I like that. There's that word that we hear all the time nowadays in a transparent manner, but it's clearly true inside of corporate governance. All right, so let's take a look at some of these mechanisms to manage this relationship and to lessen the associated risks. All right, and these are pretty obvious ones here. So corporate reporting and transparency. So what do we get? What do we get from the executive? We get to go to the annual meeting, which we'll talk about in just a second. And at that annual meeting, we get an annual report. And that annual report, and you remember this from our financial statement conversations in previous readings, that financial report has a ton of financial information, but it also has a ton of non-financial information. And then we can look outside of the business to kind of external stuff. We get all sorts of information there. And why do we need this information? Oh, it reduces information asymmetry. That's probably a really good exam question. What we want to do is we want to say that, look, we can use this information to evaluate the performance of not only the company in its ability to generate cash flows, but also its managers. And so essentially what we're doing is we're evaluating the board of directors, because the board is supposed to evaluate, right? So, of course, we can make investment decisions and we can vote on matters. So we can go to the annual meeting. Every shareholder gets a proxy letter that says something like, dear Mr. and Mrs. Shareholder, you are cordially invited to our annual meeting, which will be held in the city of Cincinnati or Chicago or San Francisco. And there'll be an agenda list on there, and it'll say something like, well, election of board of directors, approvals, dividends, compensations, all different sorts of things. And we'll be able to vote. So if you come to the meeting, bring your pencil and you can go ahead and vote. If you don't want to come to the meeting, go ahead and vote and send it in through the mail or do it electronically. Or if you don't want to vote at all, then you'll allow the executive leadership team to vote your shares for you. That's called proxy voting. I did mention cumulative voting in a previous slide. Let me tell you about that. If I own one share and there are 5 board seats available, I can vote for each one of those 5 people. But if I have cumulative voting and I have one share, what I can do is I can take 1 times 5, and I can take my 1 share times 5 gives me 5 votes, and I can vote for just 1. So it would be 0, 0, 0, 0, and 5 for one of those shareholders. Or I could do 0 and 2 and 0 and 2 and 1, or I could do whatever mathematical combination that you could come up with. Shareholder activism. I would love to spend the next 27 hours just telling you all about this. Part of my dissertation was on poison pills, better known, I should say lesser known as shareholder rights plans. And so, I wrote my dissertation in 1993 or so, and this was really, kind of the beginning of shareholder activism. And so essentially, shareholder activism just means that, a group of shareholders get together and they say something like, we think these executives stink. Maybe they stink in general, a general stinkiness, or they stink at this, or they stink at that, or maybe we'll rank their level of stink. I'm guessing that you have figured out that stink is not, that's not a word I got from the reading. And so what we do is we use our collectivism to influence the company. And this happens all the time. Again, read the Wall Street Journal. You'll see articles about this. So look down forms of activism, engagement, stewardship, proxy fights, proposing shareholder resolutions. So that's the whole deal with my dissertation with a poison pill that firms. The Supreme Court of Delaware ruled that the executive leadership team did not need approval by the shareholders to adopt a poison pill. That's why they called them shareholder rights plan, because who in the world would be in favor of something that's poisonous? Now, of course, what shareholders can do is they can just sue the board of directors. They can say, you know what, we don't like what you've been doing. You're not putting the company in the appropriate strategic plan. And have you evaluated your executive leadership team lately? Look at these individuals. Look at what they're doing. They're running the company into the ground. And then, of course, there's this market for corporate control. If we're influential enough, what we can do is we can use our influence to maybe promote a takeover or an acquisition, and we can do this a couple of different ways. Because you think about it, what happens in many times there are friendly mergers, and so these are two people. It's like a marriage, two people, they get together, they love each other, and everyone's happy. So you have two firms, the executive leadership team of both firms, they like each other, and so they get together and nobody gets fired. But the problem then becomes when the one firm says, we're going to take over this firm and we're going to fire all those people. So this then results in chaos. So tender offers, sometimes they can be friendly, but a lot of times they're not. But a lot of times those tender offers become hostile. So the sense here is this shareholder mechanism is that the threat of a takeover is going to align the executives with the shareholder goals. Now, how about mechanisms for the top right of the balance sheet? So the bond indenture, this is the legal and binding document that outlines, all the stuff that's going to happen. So if I'm Jim's Concrete Company and I issue a bond, this is, I make a legal promise that if you lend me $1 billion today, I'm going to repay you your $1 billion, and I'm going to pay you a coupon rate. Let's say it's 5 or 10%, whatever that number is. And I'm going to do it over 10 years or 20 years or 30 years. And so this indenture contains all of the legal terms and conditions. And, over the years, I've read a bunch of these. I don't really recommend that you do this, but you can find these online pretty easily. They're fairly dull, but some of these, in fact, most of them are going to contain covenants. Some of them are going to be positive covenants that say something like, oh, the firm should do this and this and this. And then some will be negative, like the firm is not allowed to do this and this or this. Like the firm is not allowed to pay a dividend if it doesn't pay an interest payment. And then, of course, one of the important components of the indenture is what kind of collateral, if any. A lot of these bond issues, especially for large corporations, are unsecured. Inside of the indenture, there'll be a sentence that reads something like, the general ability of the firm to produce operating cash flows, it will be sufficient to repay this loan. But lots of bond issues, of course, are secured. And so if I were Jim's Concrete Company, it would say something like, look, Jim's going to take his cement truck here. That's going to be one piece of collateral. And then he owns a bunch of land over there that has sand underneath it. That's another piece of collateral. And then he has a bunch of rocks over there. That's another piece of collateral. So what does collateral do? It lowers default risk. Once again, we can go back to corporate reporting and transparency. I think that's pretty self-explanatory. And then, if you or I fail to make our car loan payments, what happens? Someone will show up in our driveway and they'll have another key to the car and they'll just start it up and they'll drive away. They'll repossess our car, and that's pretty much the end of the story. However, when you're dealing with a large corporation that has tens of billions of dollars in bond issues, and, let's just say hundreds of thousands of bondholders spread throughout the world, it's not quite as easy as coming in and starting up a car and leaving with it. And so, of course, you need a judge, you need bankruptcy court, but you need a creditor committee, which is going to act in the interests of the bondholders to say something like, that truck that Jim used as collateral, that particular truck, it has a flat tire. We don't want to sell that. But that truck over there, that's a beautiful one. Let's go ahead and substitute that truck. So this creditor committee, kinds of attempts to negotiate and discuss and restructure and all that kind of good stuff. Board of Directors, there's probably not anything on this slide that I haven't mentioned before. Provides oversight, serves as a link. We know all that stuff. Yeah, what's the bottom there? Functions include Audit Committee. What does that mean? The Audit Committee is probably made up of at least the accountant. Like the Johnson & Johnson board has one accountant on it. And clearly that individual is on the audit committee. And so the auditors will know, do the debits go over here? Do the credits go over here? And there are governance committees. And this is super important, especially in the last 30 years. So this committee establishes and monitors all the stuff that we've been talking about, for the last 30 minutes or so. There's also a compensation committee. I talked about that before. They determine what kind of compensation is fair and reasonable for the executive leadership team. And what's the goal here? To align the goals of the business with the goals of the executive leadership team. Nomination committee. This is important because what we don't want is that we don't want a board member to sit on the board for 100 years, because sooner or later that board member is going to be quite familiar excuse me, and quite friendly with all the executive leadership team, so that their independence might be questioned. So there's probably an optimal time that a board member sits and serves on a board. So what the nomination committee does is it's responsible for saying, okay, Jim, you've been on the board for 4 years, and we love what you've been doing. How much longer do you think you want to serve? And I might say 3 years or 2 years, and they'll say, okay, that's fine. We're okay with a 7-year term, but we need to find somebody who's going to replace you. And they'll probably ask me, hey, do you have anybody in mind? And so what the nomination committee will do is I'll probably give them 2 or 3 names, and other board members and other people out there will say, hey, you know what? I hear Jim wants to resign his board position. I think Betty over there would be a great replacement. And so the nomination committee is responsible for having a seamless board over time. Oh, risk committee. This is so important. I love this one. Because in the last 10 years or so, at least since 2008 financial crisis, that firms now have a chief risk officer that is responsible for establishing and maintaining a risk culture throughout the firm. And so, as you can imagine, there would be a risk committee. All right, how about employee mechanisms to manage this principal-agent relationship? All right, so, as an employee, they have a contract. So, I sign a contract every year for my school, and that contract says something like, Jim, you have to teach these number of courses, you have to have this many office hours, you have to advise students, you have to do research, you have to do stuff. And in return, what we'll do is we'll pay you for all of those services. And so that gives me rights and responsibilities, and those probably can be coordinated through human resource department. But then when we get outside of the business, there are laws. Somewhere along the line, if my school said to me, you know what, Jim, this semester we are requiring you to teach 20 courses. And I'll say something like, well, I don't really have the time or the expertise to teach 20 students, to 20 courses, do we even have the students? But it's really not in my contract, so I'm not quite sure that you can force me to do that. So we have all these labor laws out there. And these are important in terms of determining things like, and I'm just going to use a general word out there, in terms like fairness. What's reasonable? What can be reasonably expected in this relationship between the employer and the employee? Now, I think a great exam question inside of this LOS, look at where we have issues there. Pension and retirement plans. So we spend lots and lots of time here, especially in level 3, on how to put together a policy statement for a pension fund. And this is super important. This will be a link between that LOS and these LOSs. Customers, of course, we have contracts. Social media, I remember when we just started having the internet at school, And I remember my students coming to me and saying something like, oh, you know what? When I buy something over there and I don't like it, I can go to this social platform and I can say, you know what? That product doesn't do any good. And I thought, wait a minute, this is dangerous. This is dangerous to have the public with a forum that's, I don't know, I don't want to say unregulated, but at least unmonitored or something. So, I'm in favor of taking my phone and smashing it with a sledgehammer, because it's clearly the marginal cost of my phone is not anywhere near the marginal benefit. So you guys know this better than I do. Social media can be used to spread information and misinformation or disinformation, etc. All right, here we go. Government mechanisms, so we can regulate and we can pass laws and we can have corporate governance codes. All right, so think about the regulations that come from the different governments, federal or local, but then what these government bodies, and these can be independent bodies. Boy, I could even say something like, the Institute has these corporate governance codes. What do we call these? The code and the professional standards. So these are guiding principles for those of us who would like to be part of the Chartered Financial Analyst designation. And so we need to live by these rules. And so we can have guiding principles for publicly traded companies. And these corporate governance codes, they can be formal or they can be informal. Here's a section on the difference between laws in different countries, civil laws and common laws. Look at that third block point down there. Common laws are common in the United States and UK, Canada. Civil law common in other European countries. So I probably remember that third block point. Here's an obvious slide here. Good corporate governance. There's the green arrow up. Weak corporate governance, there's the red arrow down. And so let me just read some of these. Stronger business connections, stronger operational efficiency, enhanced control procedures, better financial performance, reduced level of risk. And that's probably, boy, if I were creating the exam question, that's probably the one that I would focus on. And so go down to the very bottom. If we have weak corporate governance, what are we going to do? We're going to unnecessarily increase legal risks, reputational risks, regulatory risks, default risks, operational risks, systematic risks. Any liquidity risk, any kind of risk that we've talked about. All right, so remember, this is a great exam question. I would focus on risks. And then what the Institute emphasizes here are these operational risks. Remember, operational risks are those risks of losses due to things like a failed process, things like failed policies, failed systems, maybe some kind of events, or failed people that disrupt the normal business operations. And so look at that first arrow point. Weak control systems, incapable monitoring tools, right? What are they going to do? There's no way that these things are going to lead to anything but problems. So remember that we have this increase in operational risks. So what do we need? We need adequate scrutiny. We need an effective audit committee. And what this is going to do is this going to lead to better operating performance. And so what have I emphasized during this slide deck? Think about operating performance as operating cash flows. Boy, legal, regulatory, or reputational risk. I'm going to go ahead and suggest that this became super popular back in the late 1990s, especially with Enron and Global Crossing. And then, as we hit the 2008 financial crisis, which, arguably started back in the 1960s, but you have this, legal risks, they've all been defined. We still have individuals inside of these companies who break the law. But then there are regulatory risks as well, in which, companies might try to pollute a little bit more than they're legally responsible to, or some kind of regulations. But my point here is that reputational risks, these are super important. Think about a couple of hits on reputation that you may or may not be aware of. I go all the way back to when I was in high school. Are you guys even aware of this story? Some individual went into the drugstores, we called them drugstores back in that day, and bought a bottle of Tylenol where they had the capsules, and you could pull the capsules apart and the medicine was inside, and you could pour the medicine out, and some individual put cyanide in there, put the capsule back on, put the top back on, and went to the store and put it back on the shelves, and there were a handful of deaths. And so this reputational risk, buy my product and you die. I mean, that's an extreme example. But then the company came up with the coverings, and so now you can't buy anything without a seal on top of it. Whether it's the seal that's right on the rim, or maybe it's some kind of mechanism when you unscrew it. I mean, you guys know all about this. When my grandmother was still alive, she would call me over and say, "Jimmy, you need to come over and open up my new bottle of milk." All right, how about financial risks? We know about financial risks because these are risks associated with a bond issue or a bank loan. So default, bankruptcy. I'm going to go ahead and use a term that doesn't appear in this reading called financial distress costs. These are all the costs associated with explicit bankruptcy, but also the nearing of bankruptcy. Poor corporate governance. Of course, what this can do is lead to a threat of being able to make interest and principal payments. And so what are we doing here? Good corporate governance, what it's going to do is improve our transparency. And I love that word, integrity. Hopefully you guys have watched my videos on the standards, and I love to emphasize that word, integrity. There we go, independent audit. That makes perfect sense. So look at the main point at the bottom. Good corporate governance attracts investors, improves valuations and stock performance, and decreases the cost of equity. All right, so let's move to the final 20% or so of this slide deck and talk about the environment and social. All right, so what are we doing here? ESG, the integration, is the practice of considering environmental, social, and governance factors in the investment process. All right, so this is super important here. What we're trying to do is we're trying to say something like, all right, the environment and social factors, what these factors can do is help us identify undervalued asset classes and undervalued securities inside of each of those asset classes. And so let's face it, sometimes one environmental factor will be totally irrelevant, but one factor may not. One social factor may be entirely irrelevant, but another might not be. And so look at that second bullet point, relevant for two main reasons. They have a more significant negative financial effect on a company's fair value if they are managed poorly. So what we need to do is make sure we manage these efficiently so we don't fall below, right? The second reason is that some current employees and some current retirees demand that their pension funds be invested considering one or a handful of those factors. So what are those factors? Water scarcity. So what am I? I'm Jim's concrete company. So in order for me to make concrete, I need a lot of water, right? So what am I doing when I use that water? Is it just going into a drain and going into a river and then out into the ocean? Or am I trying to capture it so that I can recycle it? Hey, there's a factor that might lead, if I'm thinking about this stuff, if I'm thinking about scarce resources and allocation of resources and what I can do to improve the left-hand side of my balance sheet, the left-hand side of my income statement, then that's a win for all of the stakeholders. And so that's true for all of these things, waste management, energy efficiency. One of the coolest things that I have read about energy efficiency is that there are farmers in the Midwest of the United States that they go out after the cows are out in the pasture and they get the shovels. Now, I'm sure it's not a shovel, but when I tell my students this, I always have them envision, a bunch of men and women out there with shovels. So they pick up after the cows. They bring it back and they put it into a machine, and whatever they do with this machine, of course, I'm not a scientist or an engineer. What happens is there's some kind of gas, right? Some kind of gas that comes out of it, and they convert that gas into energy that heats the barn and heats the farm and air conditions the eggs and all that kind of stuff. So energy efficiency using a renewable resource. So I'm guessing that cow waste is probably not high on the list of environmental factors for, let's say, a financial institution, because they don't have cows walking around the lobby. Deforestation, I talked about that with Jim's concrete company moving into Jim's construction company, air and water pollution, and then the carbon emissions. So let's go ahead and decide at each individual level. You take a company like Johnson & Johnson or Procter & Gamble or McDonald's, some of these factors, the executive leadership team can influence, and some they can't. And so it's up to the board to decide which one of these. I'm going to do this again: marginal cost, marginal benefit. Social factors. And so I'm going to go back to what I was saying about those minority shareholders. Remember, what was it? 40% trying to approach the 60% from a reasonable and fairness proposition. All right, so let's go ahead and look at these social factors. And I'm going to go ahead and skip down to, what is that, the fifth one or the sixth one? I'm going to start with the treatment of workers, since we've already talked about the employees. So if we design compensation packages that are fair exchange between compensation and skill set provided, treatment of workers, if we design these original contracts, if we have that framework in our brain as board members and as executive leadership team, then that's probably going to flow upward and downward on this list. We're going to be more sensitive to customer satisfaction. We're going to be more sensitive to the health and safety of our workers, which swings back to what I was saying about the chief risk officer. Of course, we don't want to put our workers in any kind of a harm's way. I'll tell you just a quick story. One of the summers that I worked construction when I was in college, they would put me in a bucket and they would get a crane and put me over the bridge, and I would have to pull out the 2x4s and all of the framing after they poured the concrete. And I had a belt on, and I had a little thing tied to the bucket. I don't know how safe it was. I mean, I was 20 years old back then. What did I know? But nowadays there's probably way more safety issues. Community relations and charitable activities, equity and diversity. These are factors that are going to increase in their importance, and I'm going to go ahead and say this, increase in their output as it relates to cash flows. And I always like to start with the workers, and then human rights, labor standards, and data security. I'm guessing that you guys are all aware of cybersecurity issues out there and privacy. Maybe you were one of the individuals whose private information was released to the public when, a credit card company or a retailer, was hacked. And then governance, this is all the stuff that we've talked about here. Let me go ahead and mention something that we haven't mentioned here. Look in the very middle, the idea behind how to handle whistleblowers, right? If we're doing something inside of our business that is illegal, let's go to the extreme, that's illegal, and it's kind of being, let's say, unnoticed because the board is not monitoring, or because the executives are all in it together. Think of a movie out there where there's this conspiracy theory. But how do we handle whistleblowers? We want to protect them. We want to encourage them, because we don't want this extreme asymmetry of information where only a few know that this is going on, but this affects the larger society. All right, how about the ESG considerations into an investment approach? So we can have responsible investing, we can have sustainable investing, and that word sustainable, I think it's been used a lot. I'm not saying that it's been overused in the last handful of years, but I'm going to go ahead and say that I've been using that word for 1,000 years because I've always taught my students that when firms make the capital budgeting decisions, they want to invest in product lines and services that generate not just lots and lots of operating cash flow, but sustainable cash flow. That links in with the idea of developing a brand name product line, right? What does Milton Hershey know? Milton Hershey knows that if he makes chocolate bars today, he's going to be able to sell them. If he makes chocolate bars 100 years from now, he knows he's going to sell them. So that's sustainable cash flow. So sustainable investing views the lens of picking between asset classes and finding undervalued stocks as those boards of directors and executive leadership teams that not only emphasize these ESG considerations in the short term, but over the long term. So just remember that sustainable investing means long-term stuff. And then socially responsible investing. And so this is exactly what I've been saying, for the last 20 minutes or so, that what do pension funds want? If I'm an employee and I say, it's really important to me that we don't invest in any stocks that have anything to do with tobacco. I mean, that might be a reasonable request for me as a pension fund shareholder, simply because, and I've shared this with before, you could easily go read my mother's obituary. She died of lung cancer, so I don't want to invest in tobacco stocks. That's reasonable, right? So we can have negative screening. That's what I was just talking about. Throw that out. Or we could have positive screening. What we could do is say, and I'm going to just go back to the Johnson & Johnson board that I show my students, and you can look at these bios of these boards, and I might say something like, I would like to have 3 accountants with public accounting experience on the board because I have an undergraduate degree in accounting. I know how important transparency is. I know how important accurate financial statements are. I want to make sure that the cash flows that are reported in the quarterly report are accurate. So I want 3 accountants on there, right? So that could be one positive screen. There could be ESG integration. And so the problem with this is how do we find these ESG firms or these ESG asset classes? And then we can go to thematic investment, which would probably just kind of isolate, let's say renewable energy. Boy, if there's a publicly held farm in the Midwest that scoops up the cow droppings, boy, I might say something like, boy, I want that company and companies like it in my portfolio. How about active ownership? Look at the second block point there. That's probably the key word. Collaborative engagement, multiple investment teams, and then impact investment. And this is probably, the impact is defined by some other group. And so the CFA Institute mentions in this reading the Global Impact Investing Network and the United Nations. All right, so even though this reading is called ESG, the overwhelming majority of it is a focus on corporate governance. The last part is a focus on the environment and social issues. And so what I'm guessing is that the Institute, and maybe you can focus on this when you're trying to study, is that good corporate governance leads to environmental and social awareness. And so I think you should probably take the mathematics of this reading at heart. What did I say at the beginning? Maybe 70 or 80% of this is on governance, and then the remainder is on the environment and on social issues. All right, so take a look at those. I think there are 14 questions at the end of this reading. Take a look at those, and then take a look at our readings. And remember that this is, from my perspective, a super important reading, because what it does is it teaches us how a business is supposed to operate. Hey, thank you for watching. Good luck studying and have a great day.